most Canadians make the mistake and believe that a TFSA, so a tax-free savings account, is only useful when you're young. Well, not so fast. If you're retiring soon and you have not used up your space in the TFSA, this video is for you. In fact, it's a great way for you to access down payment, either for yourself, for buying an investment property, or helping your children buy their first home. Also, it's a great way to have better tax control on your retirement income. In fact, OAS clawbacks are something no one thinks about, and they can creep up really quickly. So the TFSA is a great tool to avoid those or mitigate them. So we'll talk about how that's useful. And lastly, also other ways to qualify for a mortgage is by having a lot of net income, or rather things that you've saved, so a lot of assets. So the TFSA is a very good way to qualify for more mortgage, but also protect taxes on your retirement income as much as you can. So with that, let's get started. When you move into retirement, the whole game here is you don't have to manage where you get income from. The sequencing is really, really important. You still want to get enough income to live and do what you need to do, but it's all about sequencing, and this gets really complex. So today we'll specifically dive into three things. Number one is, remember, you're likely contributing to an RRSP. That's a registered retirement savings plan. Now, at some point, you have to pull that money out, and that becomes an RRIF. That's a registered retirement income fund. As a way around, make sure you mitigate that and save as much tax as possible. Secondly, it's the OAS Clawbacks. That's old age security. There's a way that where you, of course, you get that paid to you, but your income goes above a certain amount. This is your total income from all the income sources. There can be a 15% clawback. You don't want that. And lastly, something called the widow's penalty. And essentially, if you have two people making money, and if they make $100,000 total, but it's $50,000 here, $50,000 there with each of the individuals, you both are at a lower tax bracket. One of them passes away and their income now goes to the one person. Guess what? You're now at a $100,000 tax bracket, which is a lot more costly. So we'll talk about, of course, how that works and how to mitigate it. Quick refresher, you're likely saving diligently into your RRSP, and that means that in your peak earning years, you're being taxed less on the money that you put into RRSP. So $100 goes to an RRSP. You do not get taxed on that on your yearly income. That's deferred until you're 65 or more. You're making less income, lower tax bracket. The same $100 you now can pay yourself with is taxed, let's say, 10% instead of 50%. You're making $250,000 plus, let's say, for example. That's a quick refresher. Now, still, when you pull it out through what is now an RRIF, that is taxable, albeit at a lower tax bracket. But if you want to buy, let's say, something for your grandchildren, you want to buy an investment property, you need money for down payment, you can still avoid getting taxed at, let's say, the lower tax bracket if you've got money in your TFSA. That is tax-free. So this is the first instance where instead of having a big bulk payment from your RRIF, which still gets taxed, remember, any money that's put into the TFSA, and of course the compounding interest that it gains, is tax-free. So this is the first lever of how to avoid still getting taxed on your RRIF by allocating a larger sum, especially to your TFSA. Many Canadians don't realize, again, if your income gets above a certain threshold, your old age security, OAS, gets clawed back partially. So how can a TFSA help mitigate that? So, example, well, threshold is $93,000 at this current time of recording. If you make $100,000, $93,000 is the threshold. So anything over and above that is going to be clawed back. So in this case, $100,000 minus $93,000 is $7,000. You get clawed back 15% on the $7,000. You get to pay that money back. Not fun. So that's the first thing to consider. Now, let's think about how OAS income actually works. So basically, it's determined through a formula of, well, first of all, you have to live in Canada for a minimum amount of time. It's also based off your age and based off how much income you have made. And they give you an interesting option here. My dad, remember, he was torn between the two options. One was you can start getting paid at age 65. Start getting whatever that monthly amount is. Or you can wait till the age of past 70. And what they'll do is they'll give you 0.6% more per month over and above age 65. So if you literally go, all the months in a 5-year term, that's 60 months, and you keep, upping the 0.6%, it goes up to about 35%. So you can get paid 35% more waiting 5 years or getting paid right away at age 65. Now, everyone here, I hope, knows the time value of money, or of course, opportunity cost and investing that money. Let's assume you do not invest money that you're getting at age 65 through this sort of set amount. If you don't do that, when is the breaking point of you being better off getting paid more, but at least 5 years later? Age 84. So if you're healthy and you're confident of that, then if you're gonna live past age 84, mathematically you're better off waiting till age 70, assuming you can, of course, fulfill your other expenses in other ways. Okay, that's just a fun fact for you. That's the first thing to consider with old age security, how it works, and do you get it at age 65 or age 70 and above. Putting it all together, let's say you're making your OAS income, and again, that's taxable. You're making your RRIF income. We didn't even talk about CPP, you're likely getting that. Let's say you've got 1 or 2 rental properties and you're making rental income. That can very easily creep above the $93,000 threshold of the clawback. So let's say that's all happening and now you're at basically clawback territory. And now you got to take out some more money from either, your RRIF or any of those other accounts that I mentioned, or even, potentially another income source. Now you're starting to get clawed back 15% on every dollar you get above 93,000. So if you have your TFSA and there's of course room there, you can pull from the TFSA. It is not considered income and it's not taxable. So again, if you've got room in your TFSA, great way to take out money tax-free and without affecting your 15% clawback on OAS. A quick reminder on the RRIF, that again is the Registered Retirement Income Fund. You have to actually claim that latest age 72 as early as age 65. So that's gonna be money coming to you. And by the way, if you don't actually need that money and you're probably gonna invest it anyways, you're gonna be taxed, right? The interest income, the capital gains, the dividend incomes on, assuming you put that into stocks, those will be taxed. So if you have room in your TFSA, like you would when you were younger, of course, put that into your TFSA and all of those appreciation and gains will be tax-free. So it's a little reminder that you can reinvest retirement funds into the TFSA and therefore save on taxes and capital gains. Lastly, let's talk about the widow's penalty. Again, I alluded to this. You've got a happy couple, each making $50,000. They're both in the same tax bracket. One sadly passes away. Their income, most of it should transfer to the surviving spouse. And now they're making, in this case, $100,000 at a much higher tax bracket. So they are paying more taxes than dividing $100,000 to lower tax brackets. So that becomes a problem. And if the surviving spouse needs even more income to buy a property or to do anything, interesting with that money, they're gonna have to be smart about where they actually get the extra income to not get taxed in what is now a higher tax bracket. So what do? If you have a TFSA, you can access that income tax-free without it being added to your now high tax bracket income. And of course, the aggregate $100,000 in this example. So dip into TFSA, do not keep adding more high tax bracket taxable income if you're in the situation. That's basically how that works. Now, of course, people ask me a lot, or mainly my financial advisors, I'm of course learning this from them, but they ask, what if my spouse passes away and they had a TFSA? Usually, I believe it collapses. So how do I make sure that comes over to me? And I still want to access their TFSA funds to, of course, supplement mine, take out income tax-free. So the answer that I've been told, and again, talk to your financial advisor, is a successor holder designation. If you get that ironed out, you can ensure that TFSA from the dying spouse, or the dead spouse rather, comes to you tax-free and is dipped into. Again, talk to your FA on that, your financial advisor. But again, this is just giving you another example how the TFSA, when you're in this, let's say, overtime past a certain threshold, whether it's OAS clawbacks, or in this case, just a much higher taxable bracket income because two incomes are now under one, TFSA can be a very handy tool to mitigate extra taxes if done correctly with the right professionals. Lastly, how does this apply for a mortgage situation? Again, I'll be really clear on this. If you need, let's say, a large amount for a down payment, you're retired, and if you pull it from any of the other accounts we talked about, there are tax consequences. With a TFSA, you avoid that, and that's really important. And we've given various examples of how pulling from a TFSA much better for tax purposes than any of the other still tax advantage accounts, but they're still taxable. Now also, if you save more money in your TFSA, it is part of your liquid assets. Some lenders, very few, when they qualify you for a mortgage, they look at your income. They can also look at your assets. And if your assets or liquid income in a TFSA is about a certain threshold, you'll qualify for more mortgage. Another reason why having a TFSA is super important to qualify for more mortgage and to take money out tax-free. So putting it all together, we talked about how a TFSA can be a great tool if you have room to contribute and or you've already filled it up as a way to mitigate taxes. We talked about pulling from your TFSA instead of your RRIF. Ideally, it's a way to, again, not be taxed on the RRIF. That's one. The OAS Clawback, again, if you need extra money and you've already passed $93,000, it's much better to take it from your TFSA than from any of your other retirement income sources and then start to be susceptible to the 15% clawback. And again, lastly, the survivor widow's penalty, you do not want to be taxed more at a higher tax bracket than what you've already been upgraded to. And of course, with buying a property and qualifying for more mortgage, TFSA is a great tool to dip into. So all that being said, I hope you learned a lot. Again, I'm not a financial advisor. These are all things that I've learned working with my team of experts and structuring my finances and helping my parents structure their finances. So if you are retiring soon or you've got parents who are retiring, these are all things that no one really talks about, no one really understands. So I hope you can pass on the message. And of course, if you are uncertain of how some of these things work, talk to me. I'll own the things that are within my expertise. And of course, I've got amazing advisors that I work with. Happy to make referrals there and get you going on the right foot. Thanks so much for watching and best of luck. And most importantly, please stay healthy.